According to macroeconomist Peter C. Earle, the story of gold and silver over the past several weeks reads more like a thriller than a traditional commodity price chart. Peter C. Earle is the Director of Economics and Economic Freedom for the American Institute for Economic Research, and of course he was talking about gold and silver's parabolic run, where we saw gold eclipse the $5,500 mark and silver surge past $120 an ounce, levels that just a year ago seemed like distant targets. But then headlines changed, prices took a sharp, sudden dip, and the fear narrative started to creep back in. But if you're looking at the charts and feeling a sense of whiplash, there's something you need to understand. What we're seeing right now is not a collapse. It's a structural release valve, and for the long-term holder, it might be the most healthy thing that could happen to this market. Here's the first thing to get straight. Markets don't move in a straight line forever. When you have a parabolic move, the kind where prices shoot up towards triple digits in a matter of weeks, leverage builds up. Sentiment becomes overwhelmingly bullish. The market becomes crowded. In late January, we saw a correction. Silver, which had been the star performer, plunged more than 30% from its peak. Gold followed suit, pulling back roughly 20 to 25%. To the casual observer, that looks like a crisis. To a market economist like Dr. Peter Earle, it looks like price discovery. So what triggered the move? Well, it was a perfect storm of short-term catalysts. We saw a shift in monetary expectations following the nomination of a new Federal Reserve Chair, Kevin Warsh, and suddenly the market began to price in a stronger dollar and shifting bond yields. At the same time, margin requirements on futures contracts were hiked, forcing leveraged traders to exit their positions all at once. This created a localized stampede for the exit. But notice what didn't change. Before we look at the fundamentals that are still standing, if you're trying to navigate these swings without a clear plan, you're essentially guessing. Goldco has put together a free gold and silver kit specifically designed to help you look past the daily noise and focus on the long-term trends. It's an educational resource that explains how physical assets have historically behaved during these exact types of market cycles. Just call the number on your screen or click the link in the description below to get your copy today. Now let's talk specifically about silver because it's a different beast than gold. Silver has a smaller market size and a much higher retail participation. This means it has a higher beta. It tends to overshoot in both directions. It screams up higher on the way up and it overcorrects on the way down. This volatility is not a sign that demand for silver has vanished. It's simply a reflection of how much energy is packed into a smaller market. Even after this dramatic drop, silver is still trading significantly higher than it was at this time last year. Now here's the big takeaway. Price action is not the same as fundamental value. While the paper price of silver and gold shifted last week, the core reasons for owning them have not moved an inch. Inflation concerns are still very much alive. Fiscal imbalances and government debt continue to climb. Geopolitical risks remain at a boiling point, and while retail sentiment can shift overnight based on a headline, central banks and institutional investors aren't day trading these metals. They're continuing to add them to their gold reserves as a long-term diversification strategy. They aren't looking at the now of the price, they're looking at the why of the trend. Bottom line is, corrections like this play a vital role. They weed out the speculative froth and build a stronger foundation for the next leg up. Markets that never correct are fragile. Markets that digest their gains, like we're seeing right now, tend to be much more sustainable in the long run. These drawdowns are anxiety-inducing if you're watching the ticker every hour, but they provide a valuable perspective for those planning for the next 5, 10, or 20 years. If you want to stay focused on the durable, long-term drivers of precious metals, the ones that carry no counterparty risk and act as a hedge against currency debasement, you need the right information. Goldco makes it easy to get oriented. When you request your free gold and silver kit, you'll see why thousands of Americans have trusted them to move over $3 billion into precious metals. Plus, for those who qualify, Goldco is currently offering an instant match of up to 10% in bonus silver or gold on qualifying orders. Just call the number on your screen or click the link in the description to learn more. Because in a market this dynamic, understanding the difference between a crash and a correction makes all the difference. And if you want to learn more about gold and silver's parabolic rise and predictable pullback, I'll have Peter C. Earle's article linked in the description below.